Good morning. Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we try to help you stop paying Uncle Sam so many darn taxes and start building real retirement wealth. So today's topic is, what are the rules for contributing to a solo 401k plan? We're going to go over this topic. As always, we use these daily webinars to answer all types of questions, whether IRAs, solo 401k plans, full-time employer 401k plans. So it doesn't have to pertain to today's specific topic. So go ahead, type over your questions here on the live chat. We'll pause and answer those questions as they come in. And then we'll continue with our daily topics. So let's get started. So what are the rules for contributing to a solo 401k plan? Well, in order to contribute to a solo 401k, which is also called a one participant 401k, owner only 401k, and it's also one of the most powerful retirement plans available for self-employed individuals, business owners with no full-time W-2 employees. It's a good way to maximize your retirement savings, but you first need to be eligible to even open a solo 401k plan and subsequently make contributions. So who is eligible for a solo 401k plan to contribute? Well, in order to qualify for a solo 401k plan, you cannot employ any full-time W-2 employees in your business who are not owners. So full-time generally means a W-2 employee who works 1,000 hours or more per year in your business. You can always exclude contractors regardless of how many hours they work. So if your business employs a contractor besides yourself, then you can still participate and make contributions, because you can always exclude contractors in your business regardless of how many hours they work. You can always exclude those who are under age 21 as well. So whether it's someone who is a W-2 employee, as long as they're under age 21, they can always be excluded from a solo 401k plan, regardless of how many hours they work. And as a result, you would be eligible to open a solo 401k plan and also make contributions to the solo 401k plan. So in short, the ability to A, open a solo 401k plan, and B, make contributions is not necessarily based on your self-employed entity type. So whether it's a sole proprietorship, a partnership, S corporation, or an LLC, tax of any of the above, those all qualify as long as you are actively doing work in that business, using IRS lingo, material services. So in short, you need to make sure you're able to walk the talk when you say you're self-employed. Investment income doesn't qualify. Passive income doesn't qualify as self-employment activity, or it's got to be earned income. And so if these conditions are met, your business can sponsor a solo 401k plan, and therefore you can make annual contributions to the solo 401k plan as well. So let's talk about the various types of contributions that can be made to a solo 401k plan. The first type we're going to talk about are employee contributions. So again, one of the biggest advantages of a solo 401k is that it allows for multiple types of contributions, which enables much higher annual savings than an IRA, and typically a simple IRA or even a SEP IRA, which are also plans for self-employed individuals. So from an employee contribution side of things, as the owner of the business and therefore as an employee in the business, you can make employee contributions, also known as salary deferrals. That means the same thing. Employee contributions can be made as pre-tax solo 401k contributions, which means it'll reduce your taxable income for the year because it's a pre-tax contribution. Therefore, it'll reduce your personal taxes for the year. Or you can make it as an employee Roth solo 401k contribution, which of course would not result in immediate tax savings in the year that you make the contribution. But the trade-off is that those Roth funds will grow tax-free. So depending on how well you invest your solo 401k plan, and of course how well those investments perform, you're going to grow your solo 401k tax-free. You can always do a combination of both sources. You can make employee pre-tax solo 401k contributions, as well as Roth employee solo 401k contributions. You just can't go over the allowed employee contribution limit for the year. And we'll talk about the annual contribution limits here in a little bit. So employee contributions are based on W-2 wages. If you're self-employed business, it's an S corporation. If your self-employed business is a partnership, then it's going to be based on Schedule 1, line 14, which is the self-employment income line. If it's a sole proprietorship, it's going to be based on line 31 of your Schedule C. So as you can see here, the contribution calculation is based on your type of self-employed business, whether it's a S corp, sole proprietorship, partnership. But regardless, any type of solo 401k contribution is always going to be based on your earned income from self-employment activity. Now let's talk about employer contributions, which are also known as profit sharing contributions. So there's different terminology out there to refer to employer profit sharing contributions. So with an employer profit sharing contribution, as the word employer implies, is a contribution that's made by your business. So essentially, your business may also make contributions to your plan, known as employer profit sharing contributions. If your self-employed business is taxed with an S corporation, then you can contribute 25% of your gross wages, which is line 1 of that W-2. If it's a sole proprietorship or partnership, it's approximately 20% after you subtract 1/2 of self-employment income tax. So as you can see from a contribution perspective, it's usually best if your business is taxed as an S corp. Why? Because it's going to take less earned income from self-employment activity to maximize your contributions, because with an S corporation or even a C corporation for that matter, you don't have to subtract 1/2 of self-employment income tax before performing the solo 401k contribution calculation, whether it's employer contributions, employee contributions, or even voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy, which we'll talk about more here in a little bit. So in short, with respect to employer, aka profit sharing contributions, they are always made based on your earned income from self-employment activity, and the business gets a deduction on the business tax return. So if your self-employed business is taxed with an S corporation, then that employer contribution is going to be a deduction on that 1120S corporate tax return for that S corporation, as an example. Now we're going to talk about voluntary after-tax solo 401k contributions. Now, this is actually a very popular one here. This is part of the mega backdoor Roth solo 401k strategy. And here at my solo 401k financial, we offer a plan that allows for the mega backdoor Roth strategy. And we were actually the first in the entire solo 401k industry to provide a solo 401k plan that allows for the mega backdoor Roth strategy going back to 2013. So we have thousands of clients that we've helped process the mega backdoor Roth solo 401k strategy through the years. So this is actually a very hot topic here that we constantly get questions on, and when we perform these daily webinars, we get questions surrounding the mega backdoor Roth solo 401k strategy as well. But before we continue with today's topic, which is what are the rules for contributing to a solo 401k plan, let's take a look at some questions here. So here's a question. I'm self-employed with an S Corp. My CPA says that voluntary after-tax contributions need to be tied to payroll. Is that true? No, that's not true. One of the reasons the mega backdoor was appealing to me is how flexible it seemed. I wanted to do a lump sum if I had extra cash flow. You're exactly right. So, no, regarding the comment there about needs to be tied to payroll. Instead, it appears that your self-employed business is taxed as an S corporation. Instead, you need to make sure you have the W-2 wages to support that voluntary after-tax solo 401k contribution. For example, for tax year 2025, if you have enough net self-employment income from your S corporation, so in your case, W-2 wages, box one, which is the gross wages, if you paid yourself at least $70,000 of box one gross wages for tax year 2025, you're going to be able to contribute that entire $70,000 as a voluntary after-tax solo 401k contribution, and then you're going to be able to turn around and convert that to the Roth solo 401k plan or the Roth IRA. So what is more, voluntary after-tax solo 401k contributions do not get reported on your W-2. They also do not get reported on your 1120S S Corp tax return. They do not get reported on your Schedule 1, which is an attachment to Form 1040. And the reason no reporting applies to voluntary after-tax solo 401k contributions on a W-2, on a 1120S S Corp tax return, or on your Schedule 1 attachment to Form 1040 is quite simple. That's because they're not deductible. Only if those contributions were deductible, then they would get reported on that W-2, for example, and then depending on whether it's employer or employee, they would get deducted on your S Corp 1120S, and on Schedule 1, the attachment to your Form 1040. So, in short, again, voluntary after-tax solo 401k contributions are not reported anywhere on your W-2. What is more, you have until your business tax return due date plus timely filed extension to make prior year solo 401k contributions, and that applies to all types of solo 401k contributions, whether employee, employer, or voluntary after-tax solo 401k contributions. So you actually have plenty of time to make your tax year 2025 voluntary after-tax solo 401k contribution here in 2026, as long as you do so by the business tax return due date plus timely filed extension. So if you paid yourself $70,000 of W-2 wages on your 2025 W-2, and your goal is to maximize your solo 401k contributions on the voluntary after-tax solo 401k side as part of the mega backdoor Roth solo 401k strategy, then you only need to pay yourself $70,000 of box one gross wages on that W-2, because voluntary after-tax solo 401k contributions are calculated on a dollar-for-dollar basis. It's not a percentage. For example, employer profit-sharing contributions, if it's an S Corp, it's always going to be 25% of that box one W-2 wages. Well, with voluntary after-tax solo 401k contributions, it's a dollar for dollar. So it takes a lot less W-2 wages to maximize your Roth solo 401k contributions utilizing the Mega Backdoor Roth Solo 401k strategy. That's one of the reasons why our clients that utilize the Mega Backdoor Roth Solo 401k strategy, where they're trying to contribute the overall limit for the year, so $70,000 for tax year 2025. One of the reasons they don't make any employer profit sharing contributions is because it's a percentage calculation. So yes, while you can make employer Roth Solo 401k contributions, it's going to take a lot more W-2 wages to be able to contribute up to the overall limit because it's a percentage calculation, whereas the voluntary after-tax solo 401k contribution, it's a dollar for dollar calculation. So hopefully that answers your question there, that W-2 is never used to report voluntary after-tax solo 401k contributions. Now, it's worth noting that the Mega Backdoor Roth Solo 401k strategy entails making the contribution to the voluntary after-tax solo 401k holding account. Here's an illustration of a one participant plan where this individual can make pre-tax contributions, Roth contributions, and voluntary after-tax solo 401k contributions. So it's just one solo 401k plan. So if your business is taxed as an S corporation, the S corporation would sponsor the solo 401k plan. A solo 401k plan is a defined contribution plan requiring separate holding accounts for each source of funds. So it's not three solo 401k plans, it's one plan, but you are required to have separate holding accounts, aka a bank or brokerage accounts to hold each source of funds. Of course, you don't have to make all these contribution types every year. In some years, you may make voluntary after-tax solo 401k contributions, and others you might make some pre-tax, some Roth, and some voluntary after-tax, or you may just make pre-tax contributions, but you need to have separate holding accounts for each source of funds. But again, it's not considered three solo 401k plans. It's one plan that allows for these various contribution sources, and therefore, because the solo 401k is a defined contribution plan, you need to have separate holding accounts under the plan for each source of funds. Here's an example of a two-participant plan. Let's say both spouses are self-employed in the same business. Let's say it's an S corporation. Again, it's still just one plan, but each spouse is required to have their own separate holding accounts under the plan for each source of funds. So this is an example of 6 separate holding accounts, 3 each for each spouse. That's pre-tax, Roth, and voluntary after-tax. So each spouse can actually perform the Mega Backdoor Roth based on their respective W-2 wages if their business is taxed as an S corp. So you would make the voluntary after-tax solo 401k contribution of $70,000 for tax year 2025, assuming you had W-2 wages in 2025 from your self-employed business to support that contribution. Then you would convert it to the Roth Solo 401k plan, and then we would collect information from you. But you would fill out the end plan conversion form on our website, which is how we collect the information to issue the Form 1099-R to report that conversion to the IRS. And you want to convert those funds immediately so that there are little gains, because only the gains that get converted will be taxable. Okay, let's see if we have some more questions here. But yes, we get questions all the time regarding the Mega Backdoor and reporting contributions. Now, the Mega Backdoor Roth Solo 401k conversion, as I mentioned, gets reported on a 1099-R, so I guess it gets indirectly reported. It just doesn't get reported on your business tax return when you make it, or on your W-2, for example, for S Corp self-employed business. Let's see here. Here's a question, follow-up question. My understanding was as long as the total of all contribution was less than equal to the lesser of 100% of my wages of the yearly limit, 72,500 for 2026. Yeah, so for 2026, the overall contribution limit is $72,000. For 2025, it's $70,000. So for 2026, you can choose to solely make voluntary after-tax solo 401k contributions. So that would be the $72,000. So for tax year 2025, it's $70,000. So if you're trying to make a contribution a voluntary after-tax solo 401k contribution for tax year 2025, then you still have time. But if you're trying to make it for tax year 2026, you have plenty of time. You're going to be able to make those all contribution types: employee, employer, and voluntary after-tax contributions for tax year 2026. You can do so next year in 2027 by your business tax return due date plus timely filed extension. So you definitely have more than enough time to make those voluntary after-tax solo 401k contributions. Here's a question here. I thought after-tax contributions were reported at W-2 box 14 for cost basis purposes. No, you're not required to report voluntary after-tax contributions. You can do so on the W-2, but that's optional. Most clients do not report them on the W-2, but you should. I mean, you certainly can if you want to, but it's not an IRS requirement. If you read the instructions of that W-2, it's got the word may. So you're not required to report those contributions on the W-2. Good question. Let's see if we have some more questions here. Yeah, as far as convincing your CPA, just have him read the instructions of that W-2, because again, it says it may be reported. That doesn't mean it's required to be reported. All right, let's see if we have some more questions here. To do the mega back 401k, we have to set up 3 solo 401k account, one for pre-tax, one for Roth, and one for after-tax. No, you don't. As I mentioned a little bit earlier, it's considered just one plan, but you have separate brokerage accounts for each source of funds. So technically, if you're only planning to make voluntary after-tax solo 401k contributions, you would just open up 2 separate brokerage accounts under that solo 401k plan. One to hold the voluntary after-tax solo 401k contribution, and then the second one to hold the Roth solo 401k funds. Because once you make that voluntary after-tax solo 401k contribution to that particular holding account, then it gets converted to the Roth solo 401k. And you can always open up the pre-tax solo 401k brokerage account later. That doesn't mean you're going to lose that feature. It's still available, but it can also be opened up at the time that you open the plan, so that you already have it open. So that way, when you're ready to make pre-tax contributions, or if you want to transfer an IRA or a former employer plan to the solo 401k, those would be transferred to the pre-tax solo 401k bucket. So a lot of clients like to utilize the solo 401k plan to consolidate their pre-tax IRA funds and pre-tax former employer funds. Okay, let's see here. Let's see if we have some more questions here. Here's an interesting comment here. Let's see what we got going on here. I changed from an S corp to SOPROP in 2020. With E-Trade, I created SOPROP Solo 401k in 2020 with a different plan name and sequence number, and then transfer the funds from S corp Solo to SOPROP. Different accounts, plan name, sequence number. I learned that there may be successor plan, rule, control group issued. Wanted to see if I can do the fix the issue, as I may need to send a late 5,500 easy account closure. Let's see here. But this could be viewed as operational failure, potential leading to plan disqualification or taxes and penalties, or distributed assets. I'm now also planning to switch back from SOPROP to S Corp. Want to do so. Talk about some loaded comments here. See if we can dissect that. So you changed from S Corp to SOPROP in 2020 with E-Trade created SOPROP Solo. So you have a Solo 401k with E-Trade. Then you transfer from S Corp to SOPROP. Well, keep in mind that when you change self-employed entity type, let's say you start off as a SOPROP and then you convert to an S Corp, that doesn't mean you need to open up a new Solo 401k plan. What that means is that you need to have the Solo 401k plan amended. to now list the updated self-employed business. It doesn't result in opening up another solo 401k plan. I mean, and what is more, you never want to have multiple solo 401k plans, because when you open up a solo 401k plan, contributions to that solo 401k plan are going to be based on your aggregate earned income from all your self-employment activity. So, for example, we have many clients that have a sole proprietorship business, and they also have an S corp side business, and they aggregate all their earned income from those two self-employed businesses for making contributions to the one solo 401k plan. It's a big IRS red flag if you have two separate solo 401k plans. And it's a big IRS red flag for the following reasons. Number one, the government, and rightfully so, is concerned that individuals are thinking that by opening up multiple solo 401k plans, they can double up on annual contributions, which is not the case. They can also double up on solo 401k participant loans. That's where you can borrow from your 401k. You can't borrow $50,000 from each solo 401k plan. It's aggregated between all your solo 401k plans if you are the owner of those self-employed businesses. And also another big IRS red flag for people that have multiple solo 401k plans is Form 5500 easy reporting. If you have multiple solo 401k plans, you're going to have to file two separate solo 401k 5500 easies, because you have to aggregate the value of both plans. And when aggregated, if the market value is greater than 250,000 in value, you're going to have to file a separate Form 5500 easy for each plan, even though one plan may be under 250,000 in value. As far as your successor plan rule, that doesn't come into play here. The successor plan rule has nothing to do here, because you're not closing a solo 401k plan. You're changing the business that's sponsoring the solo 401k plan from a sole prop to an S corporation. So it's an amendment. So I would go back to E-Trade and discuss that with them. Sounds like you got tangled up in some type of web there. Okay, let's continue here. So we'll come back here and take a look at some more questions in a moment. In the meantime, let's get back to our topic for today. Let's see where we stopped at. Give me a moment here. So, if this information is helping you feel more confident about your future, we would really appreciate it if you took a few seconds out of your busy schedule to subscribe to our channel, like us across the various social platforms. This helps us get the word out to other solopreneurs like yourself, and it helps us to keep building this great community. We go live practically every day, at least once, oftentimes twice a day. So we're definitely very active in this space. So that would really help us if you would subscribe to our YouTube channel and like us across the various social platforms. So we've been answering your questions here. We're also, today's main topic is, what are the rules for contributing to a solo 401k plan? So let me get back to my slide presentation here and pick up where we left off. Here we go. And we kind of talked about voluntary after-tax solo 401k contributions already by answering some of these great questions, but it doesn't hurt to keep talking about it, because the make it back to Roth solo 401k strategy is the hottest thing and next best thing since sliced bread. It's really become a popular strategy over the last 10 years, especially. We've seen tremendous increase in individuals performing the mega back to Roth solo 401k strategy. So with voluntary after-tax solo 401k contributions, not all plans allow for it. So here with my solo 401k financial, our plan does allow for voluntary after-tax contributions, which can then be converted to the Roth solo 401k through an end plan Roth conversion. That's why it's referred to as the mega backdoor Roth strategy, or it can be converted to the Roth IRA. You get to choose. So some important rules surrounding voluntary after-tax solo 401k contributions are that they are limited by your earned income. So you have to have enough self-employment earned income to justify the amount that you want to contribute as a voluntary after-tax solo 401k contribution, and you cannot contribute more than the overall limit for the year, which, as I mentioned already, is $70,000 for tax year 2025 and $72,000 for tax year 2026. And we already talked about the steps that are followed when making voluntary after-tax solo 401k contributions and processing the conversion. So the Mega Backdoor Roth strategy utilizing the voluntary after-tax solo 401k is a strategy that can significantly increase the amount of money you move into tax-free Roth status. So it's a tool to get more to indirectly get more Roth solo 401k funds in your plan than you typically can by making employee Roth solo 401k contributions and or employer Roth solo 401k contributions. Now let's talk about the solo 401k annual limits, and then we'll go ahead and let's talk about the deadlines actually, and then we'll come back here and take a look at some more questions here. So let me get to my slides here. So solo 401k contribution deadlines depend on your type of self-employed business. So if your self-employed business is taxed as an S corporation, for example, let me pull up those slides here. Let's go over that slide here. Here we go. If your self-employed business is taxed as an S corporation, then whether you're making employee pre-tax, employee Roth, employer pre-tax, employer Roth, or voluntary after-tax solo 401k contributions, or a combination of the three, you have until March 15 of 2026 to make tax year 2025 contributions. So this is actually interesting because for those that have not yet opened a solo 401k plan and they want to open a solo 401k plan in 2026 so that they can make tax year 2025 solo 401k contributions, it's actually not too late to open that plan here in 2026. If you do so, you're going to be able to make both employer contributions as well as voluntary after-tax solo 401k contributions for tax year 2025. That's if you're opening a solo 401k plan for the first time. And if your business is taxed as an S corporation, that means you would need to make sure you had W-2 wages from self-employment activity for 2025. And then if you file a business tax return extension for that S corporation, you're going to have until September 15 of 2026 to open up a solo 401k plan so that you can make both employer and voluntary after-tax solo 401k contributions for tax year 2025. Lastly, if you open the solo 401k plan by December 31st of 2025 or prior, then you have until the same deadlines, but you can make all contribution types: employee, employer, and voluntary after-tax solo 401k contributions by March 15 or September 15 of 2026 for tax year 2025. Now, if your self-employed business is a sole proprietorship, then if you have not yet opened a solo 401k plan for last year, you can open one in the current year so that you can make prior year contributions. So for example, if you open a solo 401k plan here in 2026, by April 15 of 2026, you're going to be able to make tax year 2025 contributions. And unlike an S Corp, C Corp, or partnership, with the sole proprietorship business is more favorable because you're also going to be able to make employee contributions. So you can make employer contributions, employee contributions, and voluntary after-tax solo 401k contributions for last year, so 2025. If you haven't yet opened a solo 401k plan, you can do so by April 15 of 2026. If you wait to open the solo 401k until after April 15 of 2026, But as long as you open it and fund it by October 15 of 2026, you're still going to be able to make employer profit sharing contributions and voluntary after-tax solo 401k contributions for tax year 2025. However, you will not be able to make employee contributions, as those would have to be made by April 15. Now, of course, just like an S Corp that we talked about, if you already opened your solo 401k plan by December 31st of last year, so 2025 or prior, then you have until this year in 2026 by your business tax return due date, plus timely filed extensions for a sole proprietorship, so a Form 1040 extension, you're going to have until April 15 or October 15 to make all contribution types: employee, employer, and voluntary after-tax solo 401k contributions. Partnership, so a business tax as a partnership, same deadlines as an S corporation. March 15 of 2026 or September 15 of 2026 if you file an extension, and you're only going to be able to make employer contributions or voluntary after-tax solo 401k contributions for 2025 if you have not yet opened the solo 401k plan, but you're doing so for the first time here in 2026. And just like I mentioned before, if you opened the solo 401k plan already by December 31st of 2025 or prior years, then you have until your business tax return due date plus timely filed extension for that partnership to make all contribution types: employee, employer, and voluntary after-tax solo 401k contributions. So this is some good information to be aware of, because a lot of individuals may think that they already missed the deadline to open a solo 401k plan for making prior year, in this case, tax year 2025 solo 401k contributions here in 2026 for 2025. Okay, let's take a look at some more questions here, and then we'll come back and continue with our topic for today, which is what are the rules for contributing to a solo 401k plan? So let's see here. Let's see if we have some more questions here. Uh, let's see here. Currently, I have a pre-tax account already, okay? Um, to set up a new solo 401k plan with my solo 401k financial, I have to close my previous solo account and transfer the assets to the new. Not quite. So whenever you're picking up and moving an existing solo 401k plan from one provider to another, that's referred to as a restatement. So it doesn't result in closing a solo 401k plan. You first need to understand what the definition is for closing a solo 401k plan in the eyes of the Internal Revenue Code. So when you close a solo 401k plan, that means that you need to issue a Form 1099-R and a final Form 5500 easy once that plan is closed. Well, when you restate a plan, when you switch from one provider to another, you're not closing the solo 401k plan, you're changing solo 401k plan providers. Therefore, it doesn't result in having to file a Form 1099-R or a Form 5500 easy to close the plan. So there's no successor plan rule that comes into play. The successor plan rule only comes into play when you close a solo 401k plan, not when you restate a solo 401k plan. So if you open a solo 401k plan with my solo 401k financial, you would go to our open account page. One of the questions we ask on that online application is if you currently have a solo 401k plan. We have many clients that restate their solo 401k plan from Fidelity Investments, Charles Schwab, Ascensus, T. Rowe Price, Invesco, Human Interest, you name it. They're restated from those financial institutions to our institution. and we become the solo 401k plan provider. So one of the questions we ask during that online application process is, as I mentioned, do you currently have a solo 401k plan? Obviously, the answer would be yes. And then we ask for the original effective date of that existing plan. We then populate that original plan effective date on the new plan documents, and then we restate it to our plan. So that way, the solo 401k plan maintains its history. And then we let you decide where you want to hold your funds at. Many of our clients like to hold their solo 401k funds at Fidelity Investments or Charles Schwab. Both of those institutions will provide what they refer to as non-prototype or company retirement brokerage accounts for a solo 401k offered by my solo 401k Financial. So while they also offer their own solo 401k plan, they will also offer brokerage accounts for a solo 401k offered by a third party like my solo 401k Financial, and then we'll help you to transfer that existing solo 401k plan over to our plan. So that's called a restatement. And we actually, if you subscribe to our YouTube channel, you can view over 1,100 webinars that we've performed on all types of topics. And one of those topics is how to restate a solo 401k plan from your current provider to my solo 401k Financial. So take a look at those. So hopefully that explains that. Let me see if we have some more questions here. Here's a question from Heidi. I just set up my plan in January of 2026. What are the limitations for contributing for 2025? Can I still do after-tax contributions? And then any conversion would count for 2026? Yeah, so I think I may have answered your question already, but let's indirectly when I went over this topic. But for tax year 2026, if you opened your solo 401k plan here in 2026, um, and as long as you do so by your business tax return due date plus timely filed extension here in 2026, you're going to be able to make tax year 2025 voluntary after-tax solo 401k contributions, assuming you had earned income from self-employment activity in 2025. So you would make the contribution here in 2026 to the voluntary after-tax solo 401k plan by the business tax return due date plus timely filed extension. Then you would convert those funds here in 2026 to the Roth Solo 401k or the Roth IRA as part of the Mega Backdoor Roth strategy. We actually did a webinar on this same topic a couple weeks ago. See if I can find that webinar so I can share it here that talks about the contribution deadlines versus the conversion deadlines. They're different deadlines, and individuals oftentimes get those two confused. Give me a moment here while I dig that up so I can share it with you, and then I'll keep on chiming in here. Give me a moment here. Here we go. I'm going to share the link to the page, and it's got a video there so you can read more about it as well. Here we go. So take a look at that there. But the contribution will count for tax year 2025, but the conversion will be processed in 2026. So the Form 1099-R will not be issued till January, February of next year to report the conversion that was made in 2026. So in short, the contribution deadlines are different than the conversion regulation. Now, nonetheless, it's a voluntary after-tax contribution, so it's not going to be taxable. There might be small gains. You want to convert it right away, just the small gains will be taxable. So whether it was converted this year or last year is not going to matter because it's not going to be a taxable event, except for those small gains. What is more, it's not going to impact your ability to still make a tax year 2026 contribution as well here in 2026. So you can even do a voluntary after-tax solo 401k contribution here in 2026 for 2026 and convert those funds in 2026 as well, resulting in two conversions. The one that you did stemming from your contribution for tax year 2025, and then of course the conversion stemming from the 2026 annual contribution. So again, take a look at that link I just shared with you. It's got a good live webinar that actually I'm the one that put that webinar on February 4th. So it's very timely due here. Okay, let's see if we have some more questions here. Okay. Here's a question here. I had a solo 401k with Invesco. My understanding is when I switched to my solo 401k plan documents, it was just amended. How do I fill out 5500 easy to reflect this change? So you don't file a 5500 easy to reflect a change in solo 401k providers. A 5500 easy is filed, number one, once the market value of your solo 401k plan is greater than $250,000 as of the end of the plan year. And the second time is if you close your solo 401k plan. You did not close your solo 401k plan, you restated your plan. So, in short, if you're saying that the market value of your solo 401k plan is greater than 250,000 in value, then we would help you to fill out a Form 5500 easy to report the market value of that plan being over $250,000. But if it's less than 250,000, then a Form 5500 easy does not apply. You can go to the Forms tab of our website. On the top right-hand corner, there's a tab titled Forms. Click on Forms, scroll down, and there's a section where you can request a Form 5500 Easy Preparation Assistance. Okay, let's keep going here. I also have a defined benefit plan. Does that plan affect the contribution here? It certainly does. And again, we've covered this topic at great length. If you subscribe to our YouTube channel, you can pull up a webinar on that. When you make contributions to both a defined benefit plan and a defined contribution plan, aka solo 401k plan, it's going to impact the amount of employer profit sharing contributions you can make to that solo 401k plan. Instead of being able to contribute 25% of a profit sharing contribution to the solo 401k plan, is going to drop down to 6% of a profit sharing contribution. It's not going to impact your employee contributions or your voluntary after tax solo 401k contributions. However, let me pull up a link from our website that talks about that, and you can take a look at that. Give me a moment here. Been battling a bad cold here, so pardon me here. So, excuse me. Here's a link here I'm going to share with you regarding contributing to both a defined benefit plan and a solo 401k plan. Take a look at that. The link there. Okay, let's see if we have some more questions here. Looks like we've got the gentleman following up with his E-Trade situation here. To clarify, the S Corp Solo was already closed in 2020. So I will or will not need to send a Form 5500 easy due to account plan closure. Well, I mean, it's 2026, as you can probably gather. So you would have already filed the Form 5500 easy if you closed your solo 401k plan in 2020. If you closed your S corporation in 2020, that doesn't mean that you had to close your solo 401k plan. What that means is that you had to amend that plan back in 2020 to reflect your new self-employed business. So if your self-employed business changed from an S corp to a sole prop, then you would have had E-Trade restate that plan, update that plan to list your new self-employed business. It would still be the same plan, so you wouldn't have to file a 5500 easy to close the plan. You may have had to file one if the market value was greater than 250,000 in value. So I'm not sure what happened there, but you need to go back to E-Trade on that front there. Let's see here. If we have some more questions here. Here's a question. When I convert my voluntary after tax into Roth within my solo 401k, does it need to go through my Roth account before I roll it into my Roth? Or can it go directly to my Roth from after tax? Good question. So That's one of the great things about the voluntary after-tax solo 401k contributions, and that is that you can decide whether to convert those voluntary after-tax solo 401k contributions to the Roth solo 401k plan or to a Roth IRA. So if you want to convert that voluntary after-tax solo 401k contribution to a Roth IRA, you would not first convert it to the Roth solo 401k. You would make the voluntary after-tax solo 401k contribution and then convert it directly to the Roth IRA. Now, most clients do not convert their voluntary after-tax solo 401k contribution to a Roth IRA. They instead convert it to the Roth solo 401k plan for a number of reasons. Number one, Roth solo 401k plans, just like Roth IRAs, are now subject to require minimum distributions once you reach that age, which is age 73. So that's one of the main reasons clients used to convert to a Roth IRA, but not anymore. After the Secure Act changed the regulations, now require minimum distributions from a Roth solo 401k. What is more, clients like to consolidate their retirement funds inside the solo 401k plan. They also like to take solo 401k participant loans. You can now do that from an IRA. Many of our clients like to invest in physical real estate where they utilize debt financing. When they do that with the solo 401k, it does not trigger unrelated debt finance income tax, and that tax does apply to Roth IRAs. So for those reasons, we find that the majority of our clients convert those funds to the Roth solo 401k, not the Roth IRA. And this is a good slide, the slide there to be aware of. Okay. See if we have some more questions here. Here's a question. Why contribute anything to Roth 401k portion? Why not just put all 72,000 for 2026 into the after tax and then convert it all as a lump sum? Yes, many of our clients do that. They forego making any other contribution type and they just make voluntary after tax solo 401k contributions and then convert the entire overall contribution limit, which is $72,000, to the Roth solo 401k or the Roth IRA. Some clients like to contribute some pre-tax because they want to get a little bit of a tax deduction for the year, and then they'll do the remaining amount to the voluntary after-tax solo 401k. But yeah, we find that very little clients make any Roth solo 401k contributions anymore. Most of them are either making pre-tax solo 401k contributions or voluntary after-tax solo 401k contributions. So you can certainly make some of each, but you can now go over that overall contribution limit. Here's a question here. Seems like rolling the voluntary after tax to Roth as opposed to living it in the Roth 401k, you could delay eclipsing the 250 mark and 5,500 filing, comma, yes. Not necessarily, because when you make that voluntary after tax solo 401k contribution, you're going to want to make sure that you add that amount to the total value of the plan for that entire year. So just because you converted those funds out of that voluntary after-tax solo 401k in the same year doesn't necessarily mean that you're not going to have to file a Form 5500 easy, because you have to take all that activity during the year to determine the market value of that solo 401k plan. Okay, let's see if we have some more questions here. If I wanted to convert and keep in mind, the Form 5500 easy is not it's an informational return. It's not a tax return. It's just information to provide to the IRS. And actually, many clients like to have that 5500 easy filed so that they can start the statute of limitations. When you file that Form 5500 easy for a solo 401k, you start that statute of limitations clock. Okay, here's another question. If I wanted to convert my after-tax funds to a Roth IRA, do I set that up with Schwab directly, or does my solo 401k assist with this? No, you would set up that Roth IRA with Schwab directly because we don't offer Roth IRAs. The solo 401k would be with us, and we would help you to open up the voluntary after-tax solo 401k brokerage account at Schwab, but not the Roth IRA. You would work with Schwab in opening up the Roth IRA. As a matter of fact, let me share a procedure that talks about converting voluntary after-tax solo 401k funds to the Roth IRA at Schwab. Give me a moment here. Let me share this link here with you. Take a look at go back here. There it is. Take a look at that link there. Okay. Let's see if we have any more questions here. So, looks like we got Mr. Chin back here. E-Trade does not allow plan amendment when involving employer EIN change. So what would to do if there is an entity change? Yeah, it sounds like you got tangled up on it somehow on E-Trade's web there. Um, you're gonna have to reach out to E-Trade and maybe get your CPA involved because I don't quite follow your full discussion here. And I mean, and your situation seems very specific, but in short, you should never have to close a solo 401k plan down just because you're changing self-employed entity types. That would be an amendment to that solo 401k plan. So again, you would never file a final 5500 easy if you're changing self-employed business entity types. Only if you were closing the plan down where you transfer the funds to an IRA or a full-time employer plan that you are not an owner of, or if you take a taxable distribution, would that result in having to file final form 5500 easy to close the plan? So yeah, I'm sorry, but I can't really help you any more than that. You need to go back to E-Trade where you have the solo 401k plan at. Okay. So, well, I don't see any other questions for now. So let's keep going here. We've been on for almost an hour. We're almost done here, anyways. We typically hold these sessions to a 1 hour time limit. We'll be back here again tomorrow with more great content as well. We appreciate you participating as always. So let's finish up these slides here. Give me a moment here while I get to my final slides here. So give me a moment. So we talked about the solo 401k contribution deadlines already. We talked about spousal contributions. Again, the main topic was, are the rules for contributing, what are the rules for contributing to a solo 401k plan? So we did talk already about how both spouses can participate in the same solo 401k plan as long as they are both self-employed in the same business. So it would just result in one solo 401k plan, but it would be separate holding accounts, aka bank or brokerage accounts, to hold their contributions. And the contributions to the solo 401k plan would be based on their respective earned income from self-employment activity. So for example, let's say their self-employed business is an LLC tax as a sole proprietorship. If they both want to contribute to the plan, they would each need to have a separate Schedule C under that LLC tax as a sole proprietorship, and their contributions to the solo 401k plan would be based on each spouse's separate Schedule C. So this strategy allows married couples to significantly increase total household retirement savings using a solo 401k plan. I mean, we have many clients who are married and both spouses participate in the plan, and they each perform the mega backdoor Roth Solo 401k strategy each year. So, for example, for tax year 2026, the overall contribution limit for each participant is $72,000. So, if each spouse has enough self-employment income, using my Schedule C example, if they each have enough separate Schedule C self-employment income, they can each contribute $72,000 as a voluntary after-tax solo 401k contribution and convert those to the Roth solo 401k or the Roth IRA. So talk about really supercharging your retirement account savings utilizing a solo 401k plan. So, and if you think about it, the solo 401k offers unmatched flexibility and high contribution limits, but only if the rules are followed, of course. You got to make sure you follow those contribution rules. So, some key takeaways to understand here is that all contribution types, whether employee, employer, or voluntary after tax, they have to be based on your earned income from self-employment activity. You have to have the necessary earned income from self-employment to justify or support that contribution. Also, there are different contribution types and different deadlines. So different deadlines depending on how your self-employed business is taxed, whether it's taxed as an S corp, partnership, or sole proprietorship, C corporation, for example. And there are also, you also have advanced strategies like the mega backdoor Roth strategy. You also want to make sure that you perform the required 1099-R reporting for those mega backdoor Roth strategies. And here in my solo 401k financial, we offer that service for those who timely request it. So understanding these rules allow self-employed individuals to fully leverage the solo 401k as a cornerstone of their retirement strategy. Looks like we're coming to the end of our session here. Looks like we have one more question here we can get to. If all contributions to the solo 401k are voluntary after-tax contributions, does anything need to be reported in the business tax return? No, you never report voluntary after-tax solo 401k contributions on your business tax return because you don't get a deduction. Those are after-tax funds, so there's no deduction to take. Now, those voluntary after-tax solo 401k contributions get indirectly reported to the IRS on a Form 1099-R. There's a box on the Form 1099-R where you list the total amount of voluntary after-tax contributions for the year. And that 1099-R gets issued to report that voluntary after-tax Roth solo 401k conversion. So it gets indirectly reported on that 1099-R. Now, if you think about it too, when you report that voluntary after-tax solo 401k contribution on that Form 1099-R, you're also going to report that conversion, even though it's not going to be taxable. I mean, there might be small gains that are taxable. That conversion, when it moves to the voluntary after-tax to the Roth solo 401k or the Roth IRA, we'll provide you instructions on where to report that conversion on your form on Schedule 1, which is an attachment to your Form 1040. I think it's box 5A. I don't have the number in front of me, but you literally just put, it's going to ask for the amount converted. You'll list the amount. It's going to ask for the taxable amount. You're going to put 0, or if there are small gains, you would put, let's say, $2 of gains were converted. You would put $2 there. So you would owe taxes on $2, which would be the $2 that got converted to the Roth solo 401k or the Roth IRA. All right, so that's it for today's solo 401k session. We've been on for over an hour. Thank you so much for investing your time with this. Your time is valuable. We feel that these webinars are worth it. If you haven't yet, please like and subscribe to our YouTube channel or like us across the various social platforms. Until next time, have a great rest of the day. We'll be back here again tomorrow with more content.